What's up, everyone? Welcome to the Options Trench. It is Kris and today we have a kind of an interesting topic, something that I feel a lot of people have some experience with, but there's a lot of opportunity to explore in a little more detail and specifically try to give you some practical tools that you can use in your day-to-day as we go through earnings season. So today we want to talk about earnings, and we want to talk about stock, and specifically in this case, equity behavior through earnings releases. So a quick level set. Effectively, the way that we think about earnings in general is they are commonly referred to as a binary event, one or zero. It's effectively when we get up to this event, there's a lot of new information coming out, a lot of new information. And a fun fact is a lot of people, they'll say oh my God, this stock beat on EPS to the upside, but it's cratering. Why would that be? And things like that. And there's two really big parts to an earnings release. There's confirmation about what happened over the past quarter, and then there's forward guidance, things that they're now forecasting out to the future and providing some clarity around. So effectively, what that boils down to is it's a big event. There's a lot of information coming out, and that causes a lot of really neat distortions in price behavior and in volatility behavior. So I want to talk super quick about 4 specific effects that I literally trade all the time through every single earnings cycle to give us a starting point. And then Kris is going to help us double click into one of them specifically. So if we think about an earnings event, it's typically a known calendar date. What ends up happening is, generally speaking, about 2 weeks in advance, give or take, it kind of depends on the underlying, but about 2 weeks in advance, you start to see implied volatility around the term that includes earnings starts ratcheting up. And the reason for that is we are now getting closer and closer into this unknown event. People are starting to enter the market, buy protective puts because they don't want exposure as we go through, and so on and so forth. That is actually the first effect that we can take a look at. It's implied volatility expansion into the earnings release. And like I said, it starts about 2 weeks out. Don't take my word for it. Go on to SSRN, type in the words earnings release, stock market, and then you will literally come across a litany of papers that go through all of this stuff. That's the first one. Second one, implied volatility contraction through earnings. So we have earnings while the market's closed. Market opens, all that information is now rapidly being diffused, but the unknown has now become known. So what that leads to is, again, typically speaking, implied volatility in the front contracting. Now, sometimes that contraction in the front can be overpriced, where implied volatility still trends heavy over realized. So if you're selling premium through that, you would make money. Other times, realized can come through the back door. You get a 4 standard deviation move, and on that short straddle, you get ran the hell over, and that's part of the game too. That's how this kind of thing goes. But that's the second effect, risk premium, and really that vol contraction through earnings. It's not just risk premium. You can trade skew and term structure. Third thing is the immediate pricing behavior. So sometimes if there's a big new piece of information that comes out, you'll notice a gap in the underlying. That gap can materialize into a continuation, into a reversal. And very frequently, the tenor of the day actually is defined kind of early. So you can actually ride that move a bit. So that's the second. It's kind of like that immediate price reaction. And then the fourth one and the final one is what's known as post-earnings announcement drift. And again, you can go on SSRN, type in that, or PEAD, PEAD. And there's a set of criteria that lead to higher probability events for post-earnings announcement drift. That stuff that's had a gap, a beat, or a miss. You can trade post-earnings announcement drift up or down. And it's essentially the continuation of that move in the aggregate over the next quarter. I just want to emphasize one specific point there. When I say in the aggregate, it doesn't mean one direction. You can have something that gaps up, chops sideways for 2 weeks, and then starts launching off again or whatever. And if we logically think through why that might be, what's actually happening there, it's because repricing and pricing in of information is not immediate. It's not going to happen right away. It takes time. So that ends up expressing itself over a certain duration as then other people start to see this thing moving. They're like, oh, I want to rotate some of the capital into that. And then you're kind of off in a specific direction. So those are the four. You have implied volatility expanding into the release. You have implied volatility contracting through the release. You have the immediate move following the release. And then you have post earnings announcement drift, which occurs over the next quarter. Okay, that is enough from me. Kris has a cool topic. Actually, that was the idea behind this to begin with, which he's going to talk to us a little bit about one of those specific effects through the idea of renting the straddle. Floor is yours, my friend.
Yeah, thanks, man. So we're gonna talk a little bit about this idea of the vol increasing going into earnings. And the way I think about it is, um, we'll use the example where let's just say earnings is the night before expiry. So we know that as you approach expiry, we have this big event that's coming that's going to happen right on the night before expiry. So what renting the straddle, what that trade is an acknowledgement that the straddle today is trying to price, let's say that you have 2 weeks until expiration. The straddle today is trying to balance two forces. One is that what we have, what you can call trading day volatility. So that's like, let's say it's Monday and earnings is next Friday. So trading day volatility would be, well, how much is this thing going to move around, bounce around between now and next Thursday night? And then, so there's you're sort of like your normal volatility, there, words that professionals would call this is like, they will call it a trading day volatility, or they might call it a base vol. Okay. So you have a base vol between now and say like next Thursday. And then you have your earnings move. So your earnings vol effectively. So one of the ways that the way option traders will think about pricing that vol is to say, well, okay, how much did this stock move on earnings in the past? So they might do something like look at the last 4 quarters. They might look at the last 8 quarters. They might blend some weighted average based on how, they think the more recent quarters are more relevant. They may even think about it seasonally. If you have a stock that has seasonal earnings, like a retailer where a lot of its earnings kind of happen around the holidays, they may have a different opinion about what earnings are worth depending on what quarter we're even talking about, right? The point is you have some conception of how much this stock is going to move on earnings. So the earnings move is known as, that's the straddle. You can think of that as the straddle. So what we need to do is, I'm going to use a little bit of a concrete example here because I wrote about it in January. But when I was poking around online and I had noticed that Robinhood's earnings, which was the first week of February, Robinhood vol a couple weeks out was trading around 60% IV. Now, when there's no earnings, that's about what Robinhood vol looks like. A 60% IV is somewhere around 4% moves a day, a little bit less. And that's about a normal volatility for Robinhood stock. But I noticed that the volatility that contained earnings, the expiry that contained earnings, was trading about 60 vol. So that's kind of strange. It actually sounds kind of cheap. But what we want to do is we want to quantify that a little bit better. So one thing I did is just went back and said, how much has Robinhood, I actually used ChatGPT and just asked ChatGPT, how much has Robinhood moved the last couple quarters? And you get a number that's something like it's about 8%. If you average them out, it's about 8%. So that, let's just say that the earnings straddle for Robinhood is worth 8%. And Robinhood at the time was $120. So when I was looking at this, so you expect, if the stock was going to stay there, you expect the earnings straddle to be about 8% of 120, so $99.60. So you expect the straddle to be $9.60. Well, okay, the straddle today might be something like, $15. And I know on the last day before expiration, it's going to be 960. So it's going to decay, say $5 over the next 14 days. or 13 days or whatever, and then it's going to decay, $10 on the last day effectively. So what we want to do is separate this and say, okay, my earnings is an $8 is expected to be an $8 move. What vol does that leave for the base vol for today until earnings? What is that vol that makes that equation balance? So one way we can do that is to just, I'm just going to show this little picture here. So one way we can think about that is I'm going to show you how to go from a straddle to a volatility. And from there, you can then average the volatility. I'll explain exactly how to do that. So let's say you have a move size of 8%, like I said. Okay, so what we do is we go from an expected move of 8%, which is the straddle. We have to multiply that by 1.25. The reason we have to multiply by 1.25 is because the straddle is really the mean absolute deviation. It's 80, which is not the standard deviation. It's the mean absolute deviation, or the MAD. MAD is 80% of standard deviation. So to go from a straddle, we would have to take the 8% and divide by 0.8, which is the same as multiplying by 1.25. So if you have an 8% straddle, that is a daily vol for that day, a daily standard deviation of 10%. But now we need to annualize that 10%. So we take the 10%, we just multiply that by 16. So we get an annualized daily move of 160 vol. Okay. So that's great because now we have a number that we can average with a trading day volatility to end up with what volatility we think the market should be pricing that vol with. So what was happening here is if you took the vol that was in that 60% vol that was inside Robinhood that was saying the expiry in that expiry, and you removed from it 160 vol by saying that, hey, we expect 160 vol for one day. What vol must be how much vol must there be in all the other days to end up with a 60 vol until expiration? And that number ended up being something in the low 50s. So what you ended up with is a situation where the trading day or the base vol was, let's call it 50%, and your earnings vol was considered to be was assuming an 8% move. Okay, so 50% vol is kind of cheap for Robinhood. So what you could do, and this is the idea behind the IV expansion, is that you can buy the vol today for 60. You can scalp the gamma, and you're only paying 50 vol really, because right before expiration, you're going to be able to sell that straddle out for 160 vol. Because that IV is going to go from 60 to 160, because on that last day, it's still going to be a $9.60 straddle or whatever. So you basically get to use the gamma from the straddle, from the long side, at 50 vol, and then kick it out right before expiration or right before earnings, because renting the straddle trade is not trying to make any statements about, or not trying to take a bet on how much we're actually going to move on the earnings. That would be a different strategy. Like if you had a thought about that, that would be a separate strategy. But this is just, hey, I just want to rent this thing basically until the move happens, and then I want to kick it out right before the move. And so this idea, I'm going to flip that idea, because the other thing that must be true is if you're coming at the market from the option seller's point of view, you might look at that 60 vol. In this case, even if the vol was 62, that would still be a pretty cheap trading day vol. So if you were looking at it a bit naively, you might look at the 62 vol that contained earnings and think, oh, that looks expensive. But you're not going to capture as much theta as you think, because the IV is going to go up to 160 by the time expiration approaches. So like I said before, it's not as if you're going to have $15 of straddle decay happening over 2 weeks. What's going to happen is you're going to have $5 of straddle decay happening over 13 days. And then the last $10 comes out at the end. So it's important to not fool yourself if you sell this vol into thinking that you're going to be capturing all this theta, because all the theta is going to happen at the end. even like way more so than with a traditional option where the theta kind of comes out at the end. So that's the idea. One thing I just math wise, I just want to point out if you have a 160 vol move for one day and your other days are 10% vol, you can actually can't average these things just like that. You have to square the numbers first before you average them because you have to do this in variance. So, and all variances is the square of vol. So, and I like to make a stark example of it. If you take the average of 10% vol and 100% vol, right? The average of those two numbers is 55%. But if you take the average of 10 squared, which is 100, plus and 100 squared, which is 10,000, the average of those two numbers is 5,050. And to turn it back into a vol, you have to take the square root of that. So the square root of 5,050 is 71. So if you just naively average the vols, you would get an average vol of 55, but the actual vol is 71. So we want to make sure that you just make sure that you're averaging variances and then turning it back to a vol instead of just averaging vols, which you really cannot do. So that's kind of how I would look at renting the straddle. And that was the kind of trade that was an institutional setting, very common. And I think that understanding how it's priced would help anybody, set their expectations about how does this vol behave and knowing that it's going to increase until expiration and not fooling yourself into thinking if I sell this vol here, I'm going to be capturing as much theta as whatever model I'm looking at says. That theta is wrong.
A ton of information, and I have a ton of follow-ups. Now, some of these will be pretty quick. Some of them will probably take a little bit longer. One note as I go through some of these questions that I'm sure different kinds of listeners will have is Kris has a bunch of articles literally on these exact things. If you go to his Substack and you look up Mad Straddle, you will see the math behind this and whatnot. But I just want to capture some of it here for those that I know are going to have some questions. So before, as we were going through the pricing example, you had mentioned that we use, 80%. Why do we use 80% as compared to 82% or 88%? Why 80%?
So first of all, the derivation of that's one that's like I would definitely point you to my blog. I don't, I've written the derivation of it. It's not something I store off the top of my head, but I would say this. It's actually a very, it actually just comes from, it comes from a normal distribution. If it turns out that if any variable actually is normally distributed, then if you were to compute the standard deviation, which basically takes the average of all the squares of all the numbers from the mean, and you computed just the mean deviation, the relationship will be a proportion of 80%. The MAD will end up being 80% of what the standard deviation is. But what's interesting about that is if you have any data set and you compute the MAD and you compute the standard deviation, if they differ from 80%, and they often will, it actually tells you something about the distribution. If the number is lower than 80, you have a fat-tailed distribution. So what that's saying is that, well, my typical move, my straddle, which represents my typical move, is smaller than 80% of the standard deviation. So in this example, if I think that the daily volatility is 10%, then my MAD is 8%. That means on a typical day, I sort of expect the market to move about 8%. But it turns out, like, let's say that the market typically moves only 6%. So you have a MAD to standard deviation ratio of only 0.6. What that's saying is that the reason that volatility is still so high that it's 10%, but most days we only move 6%, it must be because there are outlier moves that happen more frequently than the normal distribution would guess, right? So any data set you're looking at, if you compare the MAD to the standard deviation, you get a number less than 0.8, you know that you're looking at something that has fatter tails. So this was actually, these ratios is something I would normally compute on lots of things, like, for example, future spreads. So you could look at how much is the future spread move in a typical day. It was to trade oil options or oil futures and future spreads. So you might look at the oil futures market and say, well, the future spreads, maybe the 1 month, 2 month future spread moves like say 8 cents a day. But if you compute the MAD of that and the standard deviation of that, you would find that the ratio was much less than zero point 0.8, which is saying that those future spreads, they actually don't move that much most days, but some days they have enormous moves. And that is how you're ending up with that, whatever that standard deviation is. So certain markets, that ratio will differ. And so the lower that MAD to standard deviation ratio is, if it's less than zero point 0.8, the fatter the pricing of the out of the money options should be, the sort of like the tail option. So right away, just computing that on anything you're looking at is very informative and can probably inspire lots of your own trading ideas by saying like, hey, wait a minute, this thing doesn't really move that much a lot of the time, but when it does move, it sometimes makes these giant moves. And then how should that inform how I structure my trades? Also, anything that's really, really skewed, anything that has a lot of skew to it, that's very binary, will have this property of the MAD being much less than the zero point 0.8 ratio. So what that does is you should be very, very careful about selling options on things that seem to not move a lot because all of the risk is actually being hidden in these very uh, unexpected but very large moves. And your typical sample is not representative of the risk. And that's the best example I could give of that is something like video poker. Like it's if you play video poker, the expectancy from playing video poker, let's say you're playing a totally fair machine where all the odds are correctly priced, you know, most of the time you're going to come out a loser. But that's because the royal flush happens, one in however many thousand, I'm not sure how often it happens, but like let's say it happens one in every 20,000 hands or whatever. That is driving a lot of the expectancy. So if you were to like just look at your typical results, it would lead you into thinking that this machine is bad. But that's because it relies so much on that one crazy event to come back to like what your average expected return would be. So anything that where a lot of the return is driven by a small number of moves, that's going to happen. Those are going to be names where the tails are fat and the MAD to standard deviation is less than zero point 0.8. So it's just a super useful ratio for anything.
Another piece of that equation was using the number 16 to scale time. Why 16?
Oh yeah. So if you have because if we just assume that there's 251 trading days in a year. Used to be 252, but since Juneteenth, I believe is 3 years old. So that's another holiday in there. So there's 251 trading days in a year. With the square root of 256 is 16. So technically you should multiply by the square root of 251 to annualize these vols. But you can just use 16 to do it in your head.
Next, the overall idea of buying the straddle, gamma scalping to capture the movement, offloading right before earnings. It sounds like a slam dunk home run, gonna work every time because we know these things are gonna happen. So why is that not the case? When does it break?
Well, it'll break in any circumstance where if simply you can buy vol if you buy vol at 50 and it ends up realizing 40, you are going to end up paying more theta than the amount of money you make in gamma scalps. And of course, you don't know nobody knows the future. We don't know what the realized vol is going to be. It's like your whatever process you use to determine that 50 vol was cheap is going to be vulnerable to it just being wrong, which is the nature of all trading. So it's not a slam dunk in the sense that if you buy 50, we may end up realizing 40 and you're going to lose to this. But um, the critical part is to understand that that 50 is still going to go up because there's earnings in the future. It doesn't mean you're going to win on renting the straddle. Like you're still paying theta. There's no doubt. So it's not it's there's nothing about it that's a slam dunk. If you end up realizing only 40, you're going to lose. So but this is true of being long or being short options.
And another thing that I don't know if a lot of people think about is how do you think about the point to point vol estimate of the trader that buys the straddle and then does no gamma scalping, and then they're just essentially making two time estimates? What do you think of that?
Yeah, so that's a really fun topic because I think that there's a misconception that you need to hedge every day, every hour, or some amount in order to sort of like capture the volatility. That's false. It's what it does is it reduces the noise between the volatility that ends up happening and the volatility and your trading strategy. It's you're reducing noise. Like hedging, scalping is a form of hedging. It is trying to what it's saying is like I'm going to scalp because if my thesis here is that the vol is cheap and I buy it, and let's say that the stock goes up a whole bunch, so I'm long a bunch of delta. If you started out with a vol trading thesis and now you're long a bunch of delta, you're now introducing a bunch of risks that you didn't have a view on, right? You're not trading for to have the delta. So what happens is like your thesis and your expression of the trade are out of sync with one another. And that's why we'll gamma scalp because the idea is like, well, we want to be trading vol. But if you don't trade vol, you are if you don't actually scalp it, you're still trading vol because if let's say you buy a straddle and the stock goes to zero, like you're gonna win a whole bunch. And if the stock goes to and if the stock goes up 3%, down 3%, and you scalp all those and it ends up in the same place, you might win to that too if you're buying less than 3% moves on it. But what's happening is the less you trade, the more the noise of the path is muddying up your P&L. So the decision to hedge is mostly about how much risk tolerance you want to have in your thesis, in your trade, how many deltas you want to run. You might be, it would kind of stink to be right about the volatility, but then lose because you were long a bunch of delta at the top. And even though you were completely right about the realized vol that ended up happening. So if you want to minimize that, you can either scalp, and then the alternative to scalping is let's say you didn't really want to scalp. You could just trade lots and lots and lots of names. I'm not recommending this exactly, but like you could trade tons of names and have a huge sample size and just let everything run and without scalping and like law of large numbers should end up if your forecasts are better than what happens in the market or like you'll win because your sample size is really large but most people are not going to do that and it costs a lot to just run like these really large books, so you probably want to scalp if you want to isolate vol, but it's a misconception to say that you must scalp to isolate vol. It's a bit underappreciated that you don't have to actually do that. It's probably better practice too, though.
And what do you think about the other management approach of just rebalancing the straddle?
Meaning, meaning that you would like if we move away from the strike and restriking the straddle as well.
Yep.
Yeah.
So
So
you doing that either based on like a price condition or based on like a time trigger?
yeah. So my thinking around that would probably have to do more with the idea of let's say I think that the vol is cheap, the implied vol is cheap, and I want to own it. So if I buy the vol, if I let's say I buy the straddle, let's say I buy it's Robinhood, whatever. Robinhood's trading $75 today. I buy the 75 straddle, and Robinhood makes a big move up to 100, makes a move up to 100. I still think the vol is cheap. My restriking decision would be driven not by, it wouldn't be driven by the time or the fact that it had made that move. If I thought the vol was cheap, I would restrike simply because I don't have Greeks anymore. Like I'm equivalent, I'm basically long like a way out of the money put at this point. I have no gamma, I have no vega. Like my there is no nothing in my book that is betting on the vol being cheap. I mean, I just own this like tail option that has very little Greeks. So my decision to restrike is to say, what is the target exposure that I'd like to have, and making sure that I trade back into that exposure again. Likewise, if I had owned that straddle and the stock went up to $100 and I thought that the vol was now expensive and I didn't want to own it anymore, I could now sell the 100 straddle. I could simply just not restrike at all, or I could just, kick out whatever options I owned. But I guess ultimately my thinking there is like it's always day zero. It's like, would I want to have this trade on now? If I do, then I should increase it. I should increase the Greeks back to the target amount of Greeks that I want to have on for that trade. And if not, then I should cut. And so yeah, it would be completely driven by like what's the target exposure I want to have on, and making sure that my position is aligned with that as best as possible.
Yeah, yeah, I completely agree with that. And there's another interesting factor that I think a lot of people don't think enough about, which is like sometimes if you're gamma scalping, the gamma scalping can hurt you. And a lot of people will go into it thinking, that, oh, this is just like a benefit of being long vol and I can gamma scalp through this. I find for at least people that are starting to get into the idea of like trying to be long vol in some different factors, that what I did a lot of was the same idea that I would have. I would just paper trade a bunch of different variants of it. So I would have the same exact idea, and then I would just track a bunch of different versions of it to get a sense of how it behaved. And I think that's like one of the best possible ways to build this intuitive understanding, because every once in a while somebody will reach out and be like, oh, I was long straddle and I was gamma scalping and it actually made me lose money. And I was like, welcome to the real world, dog. Yeah, like sometimes that's the case. So if you were thinking of, this idea of trading long vol into earnings and trying to use that as a catalyst, what are some of the specific things that you would look for as you're building the universe that you would target?
Yeah, so the way we do this, so the entire way our app is structured, the Moontower app is structured is it's a we do two things. We look at names compared to their own histories. So how is the implied vol priced relative to itself? Is it relatively high, relatively low? But also the realized vol as well. So how is the implied vol priced relative to the realized vol? And how is the realized vol in this name compared to its own history? So, if Robinhood is moving at 40 vol, that's a pretty low vol compared to its own history. So if implied vol is 40, let's say implied vol is 42 and the realized vol is 40, and the realized vol is at the bottom end of however much it ever realizes. Like it's very quiet in Robinhood, and the implied vol is 42. If that implied vol for 42 is for a week, I might not think much of it because it's like, hey, this thing is moving at 40 vol, and you could simply just continue to move at 40 vol for the next week or whatever. But if you told me that I could buy 42 vol for say 9 months in Robinhood, well, I'd be buying that with both hands, because somebody would look at that and say, well, you're paying a two vol premium. I'm like, yeah, I'm paying a two vol premium on a number that is on the low end of its range. And if I think that Robinhood's true volatility is something like 50, and I'm able to lock in vol for 9 months, I'm going to buy it for 42. So that's an element. That's the thinking behind looking at options or volatility compared to their own history. The other lens that we look at is what we call it cross-sectional, which is a fancy word for relative, relative value. So an example of that is right now in the marketplace, implied vols are structurally in a higher percentile than they typically, they were like right around like the 65 percentile across the market. If you look at broad, like the S&P, IWM, like if you look at like broad vol markets, like sort of like very liquid deep markets, implied vols are a bit elevated. They're higher than average. Well, that when I look at that, I don't say like, oh, vol's a sale because it's higher than average. It's like in any environment you're in, there are names that look relatively low and relatively high. So that is what I mean by, and this kind of comes from the fact that I came from a relative value trading tradition where my entire book overall was not supposed to be some gigantic bet on vol globally. Like, oh, all vol is low, all vol is high. That's what I would call timing vol. I don't think that that was like a great source of edge to try to time vol any more than like timing stocks is something that is easy to do. It's hard to time vol just as it is to time anything. But within any structure you're in, any regime you're in, there is some stuff that looks relatively low and some stuff that looks relatively high. And so you can always construct portfolios of longs and shorts. So when we look at the marketplace in the app, we look at the whole marketplace and we say, relatively speaking, these things look low, these things look high. And then we also have a concept of these things look low or high compared to their own histories. And when you find the intersection of these ideas, that's where we find trades.
So in general, there's a couple things that are really worth people's time, especially based on what you outlined there. And a big part of that is like just building a universe that you build a relationship with and you start to understand a little bit of what it looks like. Because a big thing that you guys will hear over time as we do episodes is, at least in my experience, a big part of trading is like understanding a baseline and then seeing when things are off that baseline for whatever reason. And then typically starting to explore it a little bit more. But we are at time. It's time for us to wrap up. Now, our episodes are built on your questions. So if there's anything that you have a question on or anything that you're interested in seeing us discuss, shoot us an email, drop it as a comment. Anything works. We look forward to hearing from you guys. You guys will see us next week, like every other week, and we will catch you guys later. Thanks, Kris.
Awesome. Peace, man.